Your car is costing you more than you think. Not just the payment, not just the gas. I'm talking about the full, honest, all-in number. The one that includes insurance, depreciation, maintenance, registration, parking, and the interest you're paying on the loan. When you add it all up, the average American is spending somewhere between $800 and $1,200 a month on their vehicle. That is a mortgage payment. In a lot of parts of this country, that's more than a mortgage payment. And for most people, that money disappears completely. Every single dollar. No return, no equity, no asset, just gone. In exchange for a depreciating machine that loses value every single day it sits in your driveway. But here's what the smartest people I know have figured out. Your car doesn't have to be a pure financial drain. With 5 specific strategic moves that cost you little or nothing to implement, you can fundamentally transform how your vehicle fits into your financial life. You can cut what it costs you, extract value from what you already own, and in some cases turn a depreciating asset into a genuine income-producing tool. Today, I'm going to show you exactly how. All 5 moves, real numbers, no theory. Let's get into it. The true cost of car ownership. Before we get into the 5 moves, I need to make sure you're looking at the full picture of what your car actually costs you, because most people severely underestimate it, and that underestimation is exactly why they never fix it. Here's how to calculate your true monthly cost of car ownership. Start with your monthly loan payment. Add your monthly insurance premium, add your average monthly fuel cost, add your average monthly maintenance, oil changes, tires, brakes, unexpected repairs, typically $100 to $200 a month when averaged over time. Add registration fees divided by 12. Add parking or tolls if they apply to you, and then add the number that almost nobody accounts for: depreciation. The average new car loses about 20% of its value in year 1, about 15% in year 2. By year 5, most vehicles have lost 40% to 60% of their original purchase price. On a $35,000 car, that's $14,000 to $21,000 in pure value destruction over 5 years, roughly $233 to $350 a month in depreciation cost alone. When you add it all up, payment, insurance, fuel, maintenance, registration, depreciation, the number is staggering. For many households, the car is the second largest monthly expense after housing. That is the leak. That is what we are going to address move by move, starting right now. Refinance your auto loan and redirect the savings. The first move costs you nothing to explore and could save you hundreds of dollars a month. If you bought your car in 2022, 2023, or 2024, or any time when interest rates were elevated, there is a real possibility that your auto loan interest rate is higher than it needs to be. Rates were pushed dramatically upward during the inflation cycle, and a lot of buyers locked in rates between 7% and 11% during that window. Here's the move. Refinance your auto loan at a lower rate and redirect every dollar of the monthly savings into an investment account. Let me show you what this looks like with real numbers. Say you have a $22,000 balance on your car loan at 9% interest with 48 months remaining. Your monthly payment is roughly $547. You refinance that loan at 6%, which is entirely achievable with decent credit in 2026. Your new monthly payment on the same balance and same term drops to approximately $517. That's $30 a month saved. $30 sounds modest, but let's extend the math. You take that $30 a month and you invest it. Over 10 years at 8% average annual return, that's nearly $5,500. Over 20 years, it's close to $17,000 from a $30 monthly saving. Now, let's say your situation is more significant. You have a $35,000 balance at 10% and you refinance to 6.5%. The monthly payment difference might be $80 to $120. Redirect that over 15 years and you're looking at $35,000 to $50,000 in investment value. The principle is the same regardless of the dollar amount. The savings from refinancing should never go back into lifestyle spending. They go directly into wealth building. Automate the transfer the day the new loan closes so it never touches your checking account. How do you get the best refinance rate? Pull your credit report first, know your score before you apply, then shop at least 3 lenders. Your primary bank or credit union, at least one online lender like Lightstream or PenFed Credit Union, and one other competitor. Credit unions consistently offer the most competitive auto loan rates. And if you're not a member of one, joining is usually simple and worth it for this alone. One important check: confirm the vehicle's current market value before refinancing. Most lenders will only refinance up to 100% to 125% of the car's current value. If you're underwater on the loan, meaning you owe more than the car is worth, refinancing may not be available until you've paid down the gap. But for the majority of people with a manageable loan-to-value ratio, this move is the fastest, lowest effort way to immediately reduce your car's monthly financial drain. The car didn't change, the payment did, and the difference goes to work for your future. Restructure your auto insurance, the most overpaid bill in your budget. Let me ask you something. When did you last shop your auto insurance? If the answer is, when I bought the car, you are almost certainly overpaying, significantly. The insurance industry operates on a simple behavioral reality. Most people set up auto insurance and never revisit it. Premiums quietly increase at renewal. Rates for loyal customers drift upward. And because the process of shopping feels tedious, people pay hundreds of dollars a year more than they need to. Here's the data. Studies consistently show that drivers who shop their auto insurance every 12 to 24 months save an average of $400 to $800 per year, compared to drivers who stay with the same carrier without reviewing. That's $33 to $67 a month, every month, for doing about 2 hours of work once a year. But the move isn't just to shop, it's to shop strategically. Here's how. Step 1. Assess whether your current coverage still makes sense for your vehicle. If you're driving a car worth $6,000 or less, ask yourself whether you still need comprehensive and collision coverage. These coverages pay out based on the vehicle's actual cash value. So if your car is worth $5,000 and your comprehensive plus collision premium is $1,200 a year with a $1,000 deductible, your maximum net benefit from a total loss is $4,000. Is paying $1,200 a year to protect a $4,000 net benefit the best use of that money? For a lot of people with older vehicles, the math says no. Dropping to liability only on an older paid-off vehicle can save $800 to $1,500 a year immediately. That's a real number, but run the math specifically for your vehicle and your premium before making this call, and make sure you have the financial cushion to replace or repair the vehicle out of pocket if needed. Step 2. Increase your deductible. If you're currently carrying a $250 or $500 deductible, raising it to $1,000 or $1,500 typically reduces your comprehensive and collision premium by 15% to 30%. If you have a solid emergency fund, and you should by now, you can self-insure that deductible gap. The premium savings often pay back the higher deductible in less than 2 years. Step 3. Bundle and optimize discounts. Most major carriers offer meaningful discounts for bundling auto and home or renter's insurance. They also offer discounts for good driving records, low annual mileage, paying in full upfront rather than monthly, going paperless, and in some cases, installing a telematics device that tracks your driving behavior. If you're a low-mileage driver or a careful driver, telematics programs from companies like Progressive Snapshot or State Farm Drive Safe and Save can cut premiums by 10% to 30%. Step 4. Get competitive quotes before every renewal. Set a calendar reminder 45 days before your policy renewal date every year. Get at least 4 quotes: your current carrier, 2 competitors, and 1 independent broker who can shop multiple carriers simultaneously. The independent broker is particularly powerful because they do the comparison shopping for you. The money you save on insurance every month doesn't disappear. It gets redirected into your investment account, your emergency fund, your debt paydown. That's the move. Not just saving the money, deploying it somewhere that builds your future. Turn your car into an income-producing asset. This is the move that most people haven't considered, and it's the one that most directly transforms your car from a liability into something that actually generates returns. There are several legitimate, accessible ways to extract income from a vehicle you already own. Let me walk through the most effective ones. Strategy 1. Rideshare and delivery driving. The most obvious option: Uber, Lyft, DoorDash, Instacart, Amazon Flex. If you have a qualifying vehicle and a clean driving record, you can be generating income from your car within days of applying. The financial reality here: Active rideshare drivers in mid-size to large markets typically earn $18 to $28 per hour after platform fees, before expenses. After factoring in fuel and incremental vehicle wear, net earnings are typically in the $14 to $22 per hour range. 10 hours a week of rideshare driving generates roughly $560 to $880 a month in gross income. For someone with a car payment, that's potentially covering the entire loan payment from the car itself. The critical discipline: that income must be directed deliberately. If rideshare earnings go into your checking account and blend into your general spending, the income is real, but the financial benefit is invisible. Create a separate account. Every rideshare dollar goes in. From there, it goes to your car payment, your investment account, or your debt, depending on your current financial priority. Also important: if you use your vehicle for rideshare or delivery work, track your mileage meticulously. The IRS standard mileage deduction in 2026 allows you to deduct a significant amount per business mile driven. This deduction can offset a meaningful portion of your vehicle expenses come tax time. And for high mileage drivers, it can result in hundreds or even thousands of dollars in tax savings. Strategy 2. Peer-to-peer car rental through platforms like Turo. This is the higher earning, lower effort model, and it's one of the more underused income strategies available to car owners. Turo is essentially Airbnb for vehicles. You list your car on the platform, set your availability, set your daily rate, and other people rent it when you're not using it. Average earnings depend on your vehicle type, your market, and how frequently you rent, but the numbers are compelling. A mid-size SUV in a mid-size city might rent for $65 to $95 a day. Renting just 10 days a month generates $650 to $950 in gross income. Turo takes approximately 25% to 35% as their platform fee depending on your protection plan selection, leaving you with net earnings of $420 to $700 a month. If your car payment is $500 a month, which is around the national average, renting your car through Turo 10 days a month could functionally cover your entire payment. The practicalities: Turo provides insurance coverage during rentals through their platform. You'll want to understand exactly what their coverage covers and how it interacts with your personal auto policy. Most personal insurers exclude commercial use, so clarity here is essential before you list. Your vehicle also needs to meet Turo's eligibility requirements, generally under 12 years old and under 130,000 miles, and you'll accumulate more mileage and wear on the vehicle. Build a maintenance reserve from your rental income to account for this. Strategy 3. Advertising on your vehicle. Companies like Carvertise and Rapify pay drivers to display advertising on their vehicles, typically vinyl wraps or partial wraps. Compensation varies based on your daily mileage and your market, but typical earnings range from $100 to $400 per month for a full wrap with consistent commuting mileage. This requires essentially no time investment. You drive your normal routes and get paid for the advertising exposure. The downside: the aesthetic change to your vehicle is temporary but significant, and some neighborhoods or employers may have restrictions or preferences worth considering. For someone who commutes daily in a busy market and is comfortable with the look, this is genuine passive income from a vehicle that would be depreciating regardless. The meta principle across all three of these income strategies: your car is a $20,000 to $50,000 asset sitting in your driveway doing nothing for 22 to 23 hours a day. Every hour you put it to work is an hour. It's generating return instead of just depreciating. Optimize your fuel and maintenance strategy. This move doesn't generate income, but it systematically eliminates a significant and often mismanaged portion of your vehicle's annual cost. And money saved with discipline is mathematically identical to money earned. Let's talk fuel first. The average American drives roughly 15,000 miles a year. At 25 miles per gallon and $3.50 per gallon, that's $2,100 a year in fuel. But the way most people buy gas is costing them significantly more than it needs to. Here's the optimized fuel strategy. Use Gas Buddy or the Waze fuel price feature to consistently buy at the lowest cost stations in your regular travel routes. The difference between the cheapest and most expensive station in a typical market is often 15 cents to 35 cents per gallon. On 15,000 miles at 25 miles per gallon, you're buying 600 gallons a year. Saving 25 cents per gallon saves you $150 a year for literally no additional effort beyond a 5-second route decision. Use a cashback credit card for all fuel purchases and pay it off in full every month. Cards like the Citi Custom Cash, the Blue Cash Preferred from American Express, or the Sam's Club MasterCard offer 3% to 5% cash back on gas purchases. On $2,100 in annual fuel spend, that's $63 to $105 back in your pocket per year. Small? Yes, but stacked with everything else, it matters. If you drive a vehicle that qualifies for regular unleaded and your owner's manual says regular unleaded recommended, not premium required, stop buying premium. Premium fuel in a regular grade engine does not improve performance or longevity. It's simply 30 cents to 50 cents per gallon more expensive for no mechanical benefit. This is one of the most common and expensive automotive myths in America. Now let's talk maintenance, because this is where the real money leaks happen. The reactive approach to car maintenance is financially brutal. You ignore the small things. The small things become big things. The big things become catastrophic things. And instead of a $150 brake pad replacement, you're looking at a $900 brake rotor and caliper replacement. Instead of a $25 coolant flush, you're looking at a $1,500 water pump failure. The optimized approach is proactive and scheduled. Keep a simple spreadsheet or even a notes app on your phone that tracks every maintenance item, when it was last done and when it's next due. Oil changes, tire rotations, air filter replacement, cabin filter, brake fluid, coolant, transmission fluid, spark plugs. Follow your owner's manual intervals, not the aggressive upsell intervals you'll hear at the quick lube shop. Speaking of which, for routine maintenance, oil changes, tire rotations, air filters, learn to do it yourself or use independent shops, not dealerships. The labor rate at a dealership service center runs $120 to $200 per hour. An independent shop in the same market typically charges $75 to $110 on a $300 annual maintenance budget. That labor rate difference could save $80 to $120 a year on labor alone. And tires, which are one of the most significant periodic vehicle expenses, buy them online from Tire Rack or Discount Tire Direct and have them shipped to a local installer. You'll often pay 15% to 25% less than buying directly from an installer's inventory, and the installation cost is typically $15 to $25 per tire wherever you bring them. Add it all up, optimize fuel strategy, cashback on purchases, correct fuel grade selection, proactive maintenance, independent shop labor rates, and smart tire purchasing. Done consistently, this cluster of behaviors saves the average driver $500 to $1,200 per year compared to the average person's default approach. That's not found money. That's your money, recovered from habits that were costing you silently. Make a strategic decision about your vehicle itself. The 4 moves we've covered so far work on any vehicle. This 5th move is different because it's about stepping back and asking a bigger question. Is the vehicle you're driving actually the right vehicle for where you are financially? Most people never ask this question seriously. They bought the car, they're making the payment, and the decision feels permanent until the loan is paid off. But it's not permanent, and the vehicle you drive is one of the largest levers in your entire financial life. Let me walk you through 3 specific scenarios where making a strategic vehicle decision dramatically changes your financial trajectory. Scenario 1, you're in a high payment, high depreciation situation. You bought a $45,000 truck or SUV 2 or 3 years ago. You're paying $750 a month. The vehicle has depreciated to $32,000 in current market value, and you have $28,000 left on the loan. So you have $4,000 in equity. Here's the strategic move. Sell the vehicle privately for $32,000. Pay off the $28,000 loan. Use the $4,000 in equity as a down payment on a reliable $14,000 used vehicle, a 3 to 5-year-old Honda, Toyota, or similar that you finance at a much smaller amount. Your payment drops from $750 to roughly $250. The difference? $500 a month. $500 a month redirected into investments for 20 years at 8% return is over $294,000. You gave up the truck. You gained nearly $300,000 in long-term wealth. The truck wasn't building that for you. Your payment was destroying it. This trade is not available to everyone. You need equity in the vehicle and the right market conditions. But if the numbers work in your situation, this is one of the most powerful single financial decisions available to a household in their 30s or 40s. Scenario 2. You're driving two cars when one would serve you. Two-car households are so culturally normalized that most people never question whether they actually need two cars. But two cars mean two insurance policies, two sets of maintenance, two sets of registration fees, and often two payments. If your lifestyle could be restructured to function with one vehicle through remote work, proximity to public transit, bike infrastructure, or strategic scheduling, dropping the second vehicle can free up $400 to $800 a month in combined costs. That's real. Even going from two cars to one and adding occasional Uber or Zipcar usage doesn't come close to the cost of owning the second vehicle. The math almost always favors dropping one. Scenario 3. You're driving an older vehicle that's starting to nickel and dime you. Here's the nuanced truth about older vehicles that the internet gets wrong in both directions. Some people say, never buy a new car, always run the old one into the ground. And some people say, if it's unreliable, cut your losses and get something newer. The actual answer depends on one thing: the projected cost of continued ownership versus the cost of replacement. If your 2013 vehicle needs $3,500 in repairs over the next 12 months, but is otherwise mechanically sound, spending $3,500 to keep a paid-off vehicle running is almost certainly better than trading into a $400 a month payment. $3,500 in repairs versus $4,800 in annual payments. The repair is the obvious winner. But if that same vehicle is facing $3,500 now, plus an anticipated $2,500 in 6 months, plus is increasingly unreliable for your commute and livelihood, the calculation changes. Get a pre-purchase inspection on a reliable used vehicle, find something with documented history in the $12,000 to $18,000 range, and make the move. The key: make this decision with data, not emotion. Get the repair estimate from 2 independent shops. Look up the reliability record for your specific vehicle and model year on sources like Consumer Reports or J.D. Power. Calculate the total projected cost of keeping versus replacing over the next 3 years. Let the math drive the decision, not how tired you are of the car or how exciting the new one looks in the lot. The vehicle you drive is not a personality statement, or at least it shouldn't be when you're building wealth. It's a tool. Optimize it like one, bringing it all together. The full financial picture. Let me stack all 5 moves and show you what the combined impact looks like. Move 1, refinance and redirect. Save $50 to $120 a month on loan interest. Redirect to investments. Move 2, restructure insurance. Save $33 to $67 a month through strategic shopping and coverage optimization. Move 3, generate income from the vehicle. Earn $400 to $900 a month through rideshare, peer-to-peer rental, or vehicle advertising. Move 4, optimize fuel and maintenance. Save $40 to $100 a month through disciplined purchasing and proactive care. Move 5, strategic vehicle decision. Potentially reduce your monthly vehicle cost by $300 to $500 through right-sizing your vehicle to your financial situation. Combined, depending on which moves apply to your situation and how aggressively you implement them. We're talking about a $500 to $1,700 monthly swing in your car's financial impact. On the low end, you reduce the monthly drain by $500. On the high end, someone who refinances, cuts insurance, rents their car through Turo, right-sizes to a lower payment, and drives efficiently, the vehicle goes from costing $900 a month net to potentially generating net positive cash flow. That is the transformation from liability to asset, not in theory, in practice. Now I want to be clear, not all 5 moves apply to every person. Someone with a brand new loan at a low rate doesn't need move 1. Someone with an older paid-off vehicle skips the refinance conversation entirely. Someone who needs their car available every day may not be a Turo candidate. But almost everyone watching this video has at least 2 or 3 of these moves available to them right now. Unimplemented, unexamined, just sitting there. That's the opportunity. And the cost of not taking it is measured in thousands of dollars a year, for years. Your action plan. Here's what I want you to do this week, not eventually, this week. Day 1. Calculate your true all-in monthly cost of vehicle ownership, payment plus insurance, plus fuel, plus maintenance average, plus depreciation. Write down the actual number. Most people are shocked by it, and that shock is productive. Day 2. Pull your current loan terms, log into your lender's portal, and find your current interest rate, remaining balance, and remaining term. Then spend 20 minutes getting 3 refinance quotes from your credit union, 1 online lender, and your current bank. See if there's a rate improvement available. If there is, pull the trigger. Day 3. Get your insurance renewal date and set a calendar reminder 45 days out to shop at least 4 competitive quotes. While you're at it, review your current coverage levels and deductibles against your vehicle's current market value. Day 4. Research what your vehicle would rent for on Turo in your market. Spend 15 minutes on the platform. Look at comparable vehicles and their average monthly earnings. You don't have to list it today. Just understand the number that's sitting unused in your driveway every night. Day 5. Pull your vehicle maintenance records. Identify what's overdue. Schedule whatever needs to be done at an independent shop. Set up a recurring reminder system for future maintenance intervals. 5 days, 5 moves, and the beginning of a fundamentally different financial relationship with a vehicle you already own. Here's what I want you to hold on to from today. Your car is almost certainly your second largest monthly expense. And for most people, every dollar of that expense just disappears. No return, no equity, no future value. Just gone. But it doesn't have to be that way. With deliberate, strategic decisions, refinancing, insurance optimization, income generation, expense discipline, and smart vehicle choices, you can fundamentally change the financial profile of a cost that most people never question and never optimize. The car doesn't change. Your relationship to it does. And that relationship, handled intelligently, is worth thousands of dollars a year and tens of thousands of dollars over the life of a wealth-building journey. If this video gave you at least one move you're going to make, hit that like button. It costs you nothing, and it helps this content reach more people who are losing money on a cost they've never looked at closely. Subscribe if you haven't already. Every week we go this deep on the financial decisions that actually shape your life. Practical, specific, and real. Drop a comment. Which of the 5 moves are you implementing first? I want to know, and I'll be in the comments answering questions. Own the asset. Stop feeding the leak. See you in the next one.